In this video, let's talk about how we might use this Promo Forma tool. Um, Obviously, we can look at historical information. We can see how changes have happened over time. So we can apply this to strategic plans. See, what would happen, again, we've talked about this several times, what would happen if you changed some aspect of operation, some aspect of um, credit granting, etc., right? So it could allow you to alter the future, right, by making decisions today, but maybe you can make them in smaller changes so that adjustments can be made. Um, we need to obviously look at continual forecasting. So if you think about those iterations that we talked about in the spreadsheet, that last column is the final estimate of the next year's financial statements. So then we can say, okay, that's year one, forecast year one. Now let's predict what will happen in year two. So you apply the same process by looking at the variables, making changes or not making changes, and just repeat that so that you can see, well, what will happen the next year. So then you're predicting year two. And then you can do, again, that last column of year one's forecast of year two is the forecast for year two. And you could repeat this over and over again so that eventually you can end up with forecasts of the future. Right? Here are the forecasted financial statements. That, of course, could flow through then, and you could look at how it would affect the ratios and the performance of the company moving forward. You can see here the current ratio obviously changes from year to year. We see there are changes here in the TIE ratio, which reflects some financing. Here's the financing mix. Debt ratio goes from 62 down to a little bit less than 60%. The debt equity ratio also declines a little bit. So again, we can see how these changes, these forecasts, can ultimately make changes in the company's performance moving forward. If we see something we don't like, we need to back off. We need to find something else to do. If we see the right thing, the thing that we would like to happen, then we can maybe take steps to move forward with that. Now, the challenge with this is it takes a little bit of time. So maybe we can find a way to do this that's a little bit quicker, right? So what if we just want to figure out how much financing we need to support a specific plan? So we have a tool or a technique. It's called the additional funds needed equation. The basic idea is we need to estimate the new assets we require. We need to identify the spontaneous liabilities. We then need to subtract any reinvested profit, and that will help us identify the actual additional funds that we need. Now, this is an estimate. It's a little bit quicker, but it can give us an answer pretty quickly how much money we might need moving forward. So what are the assumptions? We need to assume full capacity. So any increasing in sales may have an increase in assets. So if assets to sales ratios stay the same, if sales go up, assets go up. Likewise, with spontaneous liability to sales, we need to assume that that's going to stay the same. Now, the 2018 profit margin and the payout ratio, we can also assume that it's maintained, or, of course, we can make changes to that. So what are the variables? Most of these make a little bit of sense. We understand what they mean, right? I don't think we really have identified so clearly what spontaneous means. Spontaneous assets and liabilities are those things that change right with sales. So if sales change, they change. So we have a variety of ratios here for this particular company. Here we have our data. 10% sales growth, current sales are 100,000, so forecasted sales would be 110. Of course, that's 10,000 increase in sales. That's change in sales. Profit margin 7.65%. Current assets are 120,000. So capital intensity is total assets divided by sales. That's 120%. Payout ratio 54%. We have spontaneous liabilities of 7,000. So 7,000 to sales is 7%. We know the return on equity here is 9.2. Return on assets 6.95. So let's look at this ratio. We need to know the required additional assets. We're going to subtract spontaneous liabilities and subtract the increase in retained earnings. So what is the increase in assets that's needed? It's that asset ratio, where's the capital intensity ratio, multiplied by the change in sales. Go up 10,000. So we're going to need $12,000 in assets. The increase in spontaneous liabilities, we need to subtract that out. Here's the ratio to sales times the percent change in sales. So 70%, so that's $700 or 0.7 times that. And then finally, we have the increase in retained earnings. So the profit margin, 7.65. The new sales, 1 minus the payout ratio is the retention ratio, 46%. So we're going to have an increase in retained earnings of $3,800, $3,871. So the actual additional funds we would need, $7,429. Again, this gives us an idea of, what changes are going to have an influence on the overall need for funds in the future. Obviously, sales growth. The higher the growth, the larger the funds we're going to need. Capital intensity, right? The more assets we need for operations, the more additional funds we'll need. The higher the spontaneous liabilities, the smaller the additional funds needed will be. Because obviously if sales go up, then we're going to borrow, in this case, these spontaneous things are going to offset some of that need. And then, of course, the profit margin and the payout ratios will determine how much of the internally generated capital will be used to offset this additional funds needed. So let's think about how we might measure this or this need of additional funds. We have something called the self-supporting growth rate. This is the maximum growth rate we can achieve if we had no access to external capital. So in other words, how much can we grow? How much can sales grow only using profit to pay for the additional assets that we might need? Now, this is called self-supporting growth. Sometimes it's down, let me put this up here so you can see a little bit. Sometimes it's referred to as the internal growth rate. So how can we calculate that? It's the, again, we have our formula here. This is essentially our retained earnings. Divide that by the need for cash. That's 3.121%. So if we also look here in my notes, I have another formula down here. You take the return on assets and multiply it by 1 minus the dividend payout ratio. Divide that by 1 minus that amount, 3.21% is the internal growth rate. So this is the amount that we can grow and not go outside the company for any financing. So everything is done internally. So again, as long as it's less, there's no need for external capital to help us finance this growth rate. And of course, the more assets the firm requires, the lower its growth rate is ultimately going to be. So the sustainable growth rate is just an extension of this. This is the maximum growth rate the company would need before they would need to issue common stock for financing. So they've used all of the profits of the firm and they've borrowed all that they can. How quickly can sales grow before we'd actually have to be forced to go outside the company and issue common stock? Again, so we have this self-supporting growth rate, or that was the first one we had talked about. Now this is the sustainable growth rate. And now you just substitute ROA, return on assets, for ROE, which is the equity number. So now it says that sales can grow by 4.12%. If it were to grow at 4.5%, we would be forced to go out and gather funds using debt and using new common stock to finance that extra growth. And of course, in some situations, this just doesn't work, right? It depends on the kind of business. It might not be appropriate to model all of these ratios as a percentage of sales. The size of assets itself makes some sense. Maybe we can't grow sales by a certain percentage. Sometimes the terms referred to as assets are lumpy, right? You can't buy them in a graduated kind of scale. You either buy 100 million or you buy 200 million. There's no scale in between that's possible. Maybe there's some economies of scale. Maybe there's some non-linearity that we just don't have a straight line relationship. So again, the nice part of this information is it allows us to estimate how and when we're going to need money to finance the growth in sales of the company. Also gives us some indication at certain times when we're going to have excess cash so that we can prepare what to do with this excess cash. Should we go out and just save it, put it in an interest-bearing account, let it ride for a while? Or, again, if we're doing this for several years, maybe we see a trend that in the end, maybe we can go back out and buy back debt. We can, we'll have extra funds for extra projects, right? So it gives us some view, if you will, of what we think the future is going to look like. Now, of course, everybody knows that as soon as we come up with this spreadsheet, immediately thereafter, it changes because the future is never going to be exactly what we predict it to be. But if we have a plan, we can make predictions. And if we can make predictions, once the world evolves in front of us and we see what happens, we can make changes to not only the future plans, but we can look at our prediction process and maybe we can fine tune that. So in the next iteration of these plans, we can maybe try to become a little bit more precise in what we think is going to happen. So that's the end of this video. I'm sure it wasn't a lot of fun, but I hope to see you in the next video.